Here to talk about geopolitical risk as an investing factor. I love the topic of geopolitical risk because I used to be a boring old business reporter, and then Donald Trump ran for president, and then Donald Trump got elected, and he just completely changed the world of journalism. He is, whatever else he might be, he is God's gift to journalists, and he is certainly creating some interesting scenarios in the world, and there are other things going on too in Europe and lots of other places. So we're going to talk about this and how to take these things into account when running an investment portfolio. So I'm going to briefly introduce to you who we've got here. So Ellison is at the end. She's Chief Investment Officer with the University of Illinois Foundation. Marina Gross is to my right, EVP at Natixis Global Asset Management. Karen McQuiston is a Managing Director at PGIM, which is the investment business of Prudential. And Alyssa, Rieder, Chief Investment Officer at Dignity Health. So what we're going to start off by going just one by one. I'm going to ask each of these folks to actually define what they think geopolitical risk is, and explain what's changed in their world, and tell you at least a little bit about the sorts of things they do, because we've got a diverse group here and everybody does this a little bit different. So and the one other thing I'll add is I think we will take questions later on. I'm sure a lot of you probably can think of better questions than I can. So, so if you want to ask some questions, we want to leave some time for that. Ellen, why don't you talk about what is how do you define geopolitical risk, and how is this factored into what you do recently?
Thank you, Rick. I think, so investors have been dealing with political risk for years, especially those of us who have been investing in emerging or frontier markets over the last 20, 30 years. It's something that you've had to learn to deal with. I consider political risk to be part of the macroeconomic landscape that we all have to deal with. And the one thing that has changed, in my opinion, is the fact that this has become more a developed markets phenomenon, something that we probably since 2011 in the United States have started to focus on more, to talk about Brexit, the United States, populism. All these things are relatively new when you talk about developed markets.
Alyssa, you want to take on from there?
Yeah, no, I mean, I would say clearly it has to do with political risk, international relations risk, less geography, whereas I think if you looked at, asked a group of folks what 10 years ago people thought geopolitical risk, it had a lot more to do with what countries were next to different countries, how those countries were literally their landscape. And it's really moved into much more of a political as opposed to the geopolitical frame in which how people think about those risks.
So is the United States and Europe, does this play a bigger role in this umbrella thing called geopolitical risk now?
Absolutely.
Or not so much? It does.
I mean, especially with Trump, I think. But yeah, no, certainly developed markets are much on the stage. That's not to say that emerging markets aren't still very present in all this. I mean, you think about what's going on in the Middle East, you think about North Korea and the peninsula there, the South China Seas. There's still certainly a variety of areas where geopolitical risk is very present in emerging markets. But you know, as Ellen commented, having the U.S. be such an uncertain force in terms of geopolitical risk is definitely new.
Karen?
So I think political risk and geopolitical risk is such a broad spectrum of what that could mean, and that's why you're asking us to interpret
you to clarify it.
Exactly. I mean, so I think we're here because of political uncertainty, which is new for us. I mean, we've always experienced uncertainty right before elections, and there's always a relief when we know what's going to happen and what kind of policy will be in place. But given the surprise of our own election and the surprise of the other elections out there, we're all becoming just feeling more uncertain. But political risk itself also can get much deeper than that, talking about really destabilizing types of regimes. When you get into geopolitical, it's more about those interactions between countries and potential actual conflicts. So I think we've always known that the latter is out there, but they tended to be with sort of the smaller countries, and maybe it wouldn't bother us too much. But now that it's creeping into sort of just the general political uncertainty, and it's feeling more relevant for institutional investors.
Marina?
So just so you know where we're coming from, I work for a global asset management company with about $850 billion in AUM, and we do portfolio construction and asset allocation advisory work. So when I think of political risk, I think of it emanating from the legislative process, so the work of governing. I think of it as being distinctly different from economic and social risk, although those intersect at very many points. And thirdly, and you alluded to this, Rick, the manifestation of political risk in the developed markets is fundamentally different than in the developing markets. And I still maintain, even though we do talk a lot about the new regime and Trump and so forth, I maintain that political risk in the developed markets is still very much a short-term, transient, and very much a sentiment-driven factor. And actually, we've surveyed investors globally, and 7 out of 10 of the investors that we surveyed say that political upheaval or volatility is a factor that is not going to adversely affect their investment results, and rather it could stimulate some, some positive things or produce some positive results. So I think, global investors, and predominantly the developed countries, don't necessarily think of political risk as a destabilizing factor in terms of their, their investment decisions.
So you're saying Trump, Brexit, Frexit, no big deal, it'll blow over?
Well, those are different, right? So Trump, I think there's a lot of hyperbole, there's a lot of rhetoric, there's a lot of kind of bombastic sort of talk, but at the end of the day, our system is our system. So there's a sort of a legislative and policy and governmental framework that doesn't change from George W. Bush to Obama to Trump, and so the system works. It's been working for hundreds of years, and so I don't necessarily think there's a heightened political risk in the United States or in the developed countries. Now, Brexit certainly is a political factor, but the extent to which it will be destabilizing for capital markets, we've seen it. There was a very small blip of volatility, and then the markets in the UK performed fantastically after Brexit. So there was an adjustment in the currency, and there was some equilibrating, but for the most part, the markets were sanguine.
So I'll ask all of you about Brexit. Can we stop worrying about Brexit?
Depends on the company.
Okay, well, who needs to worry and who doesn't?
So, I mean, all of this really depends on your perspective. So, it's one thing to be a global equity manager. It's another thing to be an EMD, an EM debt manager. It's another thing to be an institutional investor who's taking the big long-term picture. Yep. But for, example, a global equity manager, maybe running a concentrated portfolio, they're taking a very close look at what companies are affected by this. So we may be saying, oh, it's not a big deal in the market, it came back and maybe there's a little weakness in the currency, things like that. But when you look at individual companies, you can really pick out which ones are affected. And so, maybe there's a software company, in one of the European regions who suddenly is losing contracts because the companies who had been contracting them are not sure where people are going to be. They're not sure what they're going to do.
And this has been going on for a year, so this analysis is baked in at this. It's got to be, right?
Yeah, a lot of it is, some of it was baked in before, but I think there was this big, there seemed to be a lot of immediate relief after the initial downturn, like, oh, it's not going to be that bad. But the reality is things are not settled yet. Yeah,
details still have to be worked out.
Yeah, absolutely.
Exactly. But it is,
well, it's market's job to figure out what's going to happen, isn't it?
Well,
and markets don't seem to be that worried.
We don't have certainty, but again, there are little pockets of areas where if you look at real estate in London versus real estate in some other major European cities, there have been some shifts and changes as people are trying to figure out how does our organization need to deal with a separation of a Brexit versus the rest of Europe. And so there's small pockets where you're going to see dislocations, but that's really at a level that's not as much with the folks here on the panel. That is, as Karen mentioned, really a level where if someone's managing a fund or investing in specific companies, that they're going to be looking at those companies' ability to deal with those changes that they're going to be facing.
Yeah.
Actually, I want to jump back for a second to Marina, your comment about, you used the word short-term, and I was wondering if your survey defined short-term and what the short-term impact versus long-term impact, because people also have very different views of what short-term is in this world.
Yeah, that's true. And it was more, the survey generally asked about whether political upheaval or political risk is a concerning or worrisome factor in the context of your kind of investment plan, and 7 out of 10.
But is that in the next year? Is that in the next 5 years? Is that in the next 3 months? That's
a great question, and I think it'll. So there wasn't a time frame provided, and I think it will vary depending on who the individual investors that responded. But of course, time horizon is so key, and we all think about investing in different horizons. But the thing that I wanted to get back to this really critical difference between sort of developing and developed countries is when you think about developed countries and trying to factor in political risk. The difficulty with political risk is that it doesn't conform to the sort of stochastic framework. So when we think about making investment decisions, we're trying to measure the likelihood of certain outcomes, taking hold or coming to fruition. And we base those estimates on things like fundamentals, things like patterns, things like cycles. And in political risk, you don't have any of those things to sort of weigh your decision on. So that's the real fundamental challenge in the developed markets and trying to factor in or hedge or offset political risk is there aren't really reliable inputs to be able to do a probabilistic type analysis where the results that you get are worth factoring in.
So I'm the token male on the panel, and this is kind of fun for me because all the other panelists are smarter than I am. Could you remind me what stochastic means?
It's probability. It's probability work, right? So it's really trying to estimate the likelihood of things happening based on a variety of different inputs. And that's what investing is. There's nothing deterministic about investing. It's all probability based.
But I would say that I think there was a comment made earlier that political risk is very distinctly different from economic risk, and I don't really think that it is. And it's almost for the very reason that you're mentioning, which is you can't...
Or one begets the other.
Yeah, you can't really model political... again, an EMD manager can, because that's really part of the government, and can they pay back their debt. But from a broader investment perspective, you can't necessarily... You can come up with some scenarios, I guess, in terms of political risk. But at the end of the day, what matters is the market going to turn down? Are rates going to go a certain way that matters to my institution? What happens with spreads? Do I care about that? Do I still have access to liquidity? There are a lot of things that can affect that. So what matters about political risk is its feedback to economics.
Right. So let me broaden this out just for one more question, then we'll get into emerging markets, developed, and so on. So Trump freaks out some people, but on the other hand, we don't, at the moment, for example, have a big war in the Middle East. I mean, we have had big wars in the Middle East in the early 90s. Some of the dictators there are not there anymore. We have civil wars, but they're contained to their countries for the most part, Syria. So if you had to say, so in the terms of the things we're talking about now, is the world more scary or less scary than it was 10 or 20 years ago?
Scary or uncertain? I think,
or just different. It could be scary. It
is different. Certainly, of course, it's different than it was. I think the issue that we did talk about at the very beginning with Trump and developed markets overall having a lot more uncertainty has really changed the markets. Now, I do think, as both Karen and Marina said, those are really hard to model. You can't model a 3 a.m. tweet. There's just no chance.
Silicon Valley's working on it.
I'm sure
somebody's working on it.
I think we have a lot of really exciting, innovative changes that are going on in the world in different industries, from Milken Institute areas of interest in health technology, and there's a lot of promise. There's a lot of excitement in terms of what we have. So I think there is a good reason for optimism, but I am concerned about the rising populism, and that may not be a short-term issue. The rising inequality that we have between wages and income. Broadly in many countries, and that's not going away. That's exacerbated over the last few decades. The valuation levels that we're at right now, with PEs of equities, at least in the United States, in the low to mid 20s, with the 10-year at 2.3% or so. Valuations are really extended. We're a number of years into this cycle. Political risk or geopolitical risk is not the only issue. Looking at those other issues historically, from a point where we are looking out 10 years. We're lucky if we get low single-digit returns in the markets,
and that's
really scary and and stressful for investment folks and allocators universally.
So anybody else? Are we more scared?
That's the key point. So I personally don't think that there's an increase in political risk per se. I think it's and that anything has changed. It's the investing environment that's a huge challenge, where we have basically late cycle conditions in both equities and in fixed income,
and
which are the two pillars.
To deal with that.
So where do you invest in order to get
that's
return?
just market
That's
risk, right?
market risk.
Yeah.
And that's, in some respects, the business cycle and the economic cycle. But politically speaking, it's no scare. I don't think it's any scarier today than it was 10 years ago or 20 or 50. It's just the awareness. I mean, because
well, but we have less
information
flexibility to deal with if issues do emerge or do blow up. North Korea not excluded from that. Then we sort of have less flexibility to deal with and less kind of headroom to manage through.
I think a lot of market participants are hoping that it's not scarier now, and that's why volatility is so low. And we sort of just go, ignore some of the things that happen, and vol stays low, and I don't really believe it, or that's just really political theater rather than political risk, which tends to be a little bit of the tone going on. Is that the good things will happen. The good things will go through in terms of what's being pushed, but the bad things, it's just theater.
And the price of oil, to some extent, is a reflection of geopolitical risk, and it's low, obviously. So, I mean, we probably shouldn't take for granted that things are relatively calm in the Middle East, with Syria being an exception. But
there are supply-demand issues that are impacting that too, with the U.S. coming online. So
But I think what's scary is if it's one thing to have a political regime that you may or may not agree with, whether it's in the U.S. or an emerging country or any other country. But what really matters in terms of understanding whether there can be stability is whether there's a framework around that. Like, can you predict what those policy outcomes will be based on the regime that's in there? And when you look at certain emerging countries, you might not want to invest, even if you agree or disagree with the regime. You will make a decision based on whether you can understand what the outcomes will typically be.
Are Trump's people a regime or just an administration?
But we may be in a place where we can't predict what's going to happen. And that is definitely new for us, not to be able to predict really what the regime is going to do.
Well,
okay.
I would just say that, a political risk is like any other macroeconomic risk. Typically, there's a binary outcome, and these are impossible to predict. And so I feel fortunate as an allocator of long-term capital, where I define risk as not meaning my minimum required return and not as mark-to-market volatility. A long-term time horizon goes a long way to taking care of a lot of bumps in the road. And then furthermore, even if I were accurate in my assessment of a binary outcome, I have no way of knowing how it will impact the markets I'm investing in. So our election is a wonderful example of the market dropping precipitously and then being up 15% or so since the election. Same thing in the UK, so that again, our time is limited, and I believe it's much more important to focus on those things you have a better chance of being successful at understanding. So again, endowments are supposed to have this very long-term time horizon, and the ability to step up and buy. The pound goes down 30% after Brexit. My managers on the ground in the UK are analyzing companies that can benefit from increased demand for UK-based exports as a result of a cheaper currency. So I think you can actually view political risk from the other side of the coin to take advantage of the opportunities that these often short-term dislocations can create.
So let's follow on that. And I'm not checking my email. I'm just keeping track of time. So let's talk about. We're here to talk about portfolio strategies. So I'd like to hear from each of you about things you've done differently within the last 12 months or so to either take advantage of geopolitical risk or hide from it. Who wants to go?
I mean, I can comment. One of the things we've done is at the end of January, we increased our allocation to both hedge funds and private equity and pulled back slightly in traditional fixed income and public equities. And part of that is due to valuations, but part of that is due to thinking about geopolitical risk as well. We added a little bit to our first...
So can you make the connection?
Yeah.
Connect us geopolitical risk more in hedge funds.
Sure. I mean, I think one is we allocated over the last year also to our first global macro hedge funds, partially because I think these issues are really important and are increasing in importance. Having folks who can think really carefully about them and understand where both, you know, as Ellen mentioned, the risks and opportunities are in some of these dislocations is really important. You know, we look at hedge funds as a diversifier, so with both risk and return in between fixed income and equities. And so we're looking to get some return versus some of our traditional fixed income where it's very challenging in terms of getting any returns right now, but also not taking that equity beta and really kind of having risk and return in between those. And we've had really good experience versus a number of other folks in our hedge funds, and so we feel that's a great area. And finding managers who can generate alpha, who can find opportunities on the ground and understand what risks they're taking and be smart about getting paid for those risks is really critical.
So when you do that, are you saying you are hedging against geopolitical risk in general or against specific risks?
Hiring folks who can think about those issues. And who are, you know, smart and thoughtful about how they put together their portfolio and where they want to take risks and where they don't, whether it's in credit, whether it's in interest rates, whether it's in individual fundamental equities of organizations, but thinking about where they want to take risks or whether they're betting on a particular outcome of a political election and how that might play out, or after the decision's made to forecast and see in the future where that might be. So looking at that, and then also, I mean, as Ellen mentioned, the longer term time horizon, that private equity, and folks who can really ride out bumps and get some return for the illiquidity that we're assuming in terms of allocating to them. So those are areas where we've felt like there's more potential and are trying to allocate appropriately there.
Okay, Karen?
I mean, I would say some large institutional investors are in a position to take action on their own or, you know, implement views and, you know, may have hedged right before Brexit in some way or another. But many are really depending on their managers. So, you know, you can look at equity and fix and hedge funds as examples. And so, you know, in equities, again, if it's an active manager, of course, if it's an index, you're exposed, you're just exposed. But if you're with an active manager, you know that they are taking a very close look at which companies are being affected or potentially affected and using their, you know, skill set to determine which ones are going to be winners and losers. In fixed income, you know, it's looking at sovereign debt and understanding how our policies and our trade policies and things like that are going to impact them and whether they're still able to pay their debt and making judgments on that. You know, the market may have really caused some to tank and it's an opportunity to buy risk in that sense. And then in hedge funds, you got managers who can play currency and they can play, you know, all sorts of macro bets. And that's where I just think you tend to hear institutional investors, for the most part, relying on their managers to do that for them. There's some interest in hedging, you know, overlay hedging on the whole portfolio, but it's difficult to time and it's expensive. I mean, volatility is very, very low, so that's, you know, one area where people are thinking about should I be using this in some way, the fact that vol is so low, but it's been low for a long time.
Right. Marina, things you've changed
So
recently?
what we're taking advantage of is financial technology. I mean, I think what's serving us and investors broadly is the number of and the robustness of, you know, real analytical tools that can help us understand the risks that we're taking. So the things that we've been doing is, rather than just measure sort of normal range risk, we're doing a lot to measure tail risk. And you can do that a variety of different ways. So we're trying to estimate tail risk and trying to make it more ex ante or more, you know, predictive in the future. That's one thing, because these political risk is kind of manifested in these tail events. The second thing that I think advances in financial technology allow us to do is to get kind of underneath the portfolio and x-ray it and understand the degree to which we have, you know, currency risk and illiquidity risk and those sorts of things. So a more kind of factor-based approach to analyzing the portfolio, even though you can't necessarily see and quantify everything, it's a more diagnostic way of looking at it. So in our view, there are still many blind spots, but I think professional investors are equipped with better technology to understand what their portfolios are exposed to and then how to navigate that.
These types of models, by the way, do these make a distinction between political risk, currency risk, market risk, and all their types of risk, or do you just call it risk?
Political risk, no, but underlying political risk, and there was the comment earlier about the relationship between economic risk and political risk, and I completely agree with that. They intersect and converge in lots of places. But so underneath political risk are sort of notions of, you know, inflation and currency risk and liquidity and that sort of thing. So it's not going to necessarily brand it political risk, any model, but you can sort of define what your notion or what your definition of political risk is, and then measure those underlying factors.
Yeah, okay. Ellen, you talked about finding opportunity in risk. Can you point to us to a couple specific ways you've done that?
Sure. So although we are macro aware, we're not macro driven, and I don't have any global macro managers. I have a lot of alternatives within the portfolio, but it's a highly concentrated portfolio with 37 managers at this point. And I'm really cheap. I really don't want to pay for any hedging unless it's very reasonable or totally free. So this would be buying inflation risk in January of '09. That makes sense to me. And I don't think I'm distinct amongst many endowments in not believing in the long-term success of a global macro strategy. I'll just put that out there. So in my opinion, the best way to build a portfolio against political and other types of risks is really within inherent in the structure of the portfolio. So what we've done at the University of Illinois Foundation is to set up a portfolio that is kind of driven based on role in portfolio. So I have global equity, and that's anything that's an equity of any type or stripe, including private equity and venture capital, and that is a growth driver of the portfolio. And then I have a smaller diversifying section I'm calling it global credit. It's every type of credit, public, private, everything except for sovereigns. And then it's in this final 20% that I think really deals with the category that would include political risk. And these are the natural hedges that are part of the portfolio. And I call it global macro risk hedges. This is precious metals, natural resource equities and debt, global linkers, cash and short duration debt, sovereigns, and private real estate. So this is the part of the portfolio that will perform during periods of politically triggered distress. And it will probably be a drag on the performance of the portfolio when the markets are going straight up, but during periods of duress, this 20% will be the anchor to windward. The other thing I have done is I have spent a lot of time in Latin America over the last year, and I think it is very interesting to consider that the 6 out of 8 countries in Latin America have at the same time, these are the ones with the most developed publicly traded markets, have kind of said, you know, we're done with this statist, dirigiste form of government. We are going to move more toward a Western European or American system of, you know, economic expertise, institutionalization of the economy, and so my question,
what are the 6? Not Venezuela, I assume.
No, not Venezuela. So Argentina, Brazil, Colombia, Peru, that's 4, Chile. Mexico, and Chile. So 6 out of 8 countries, that's pretty significant. So they're all moving away from populism, and the developed markets are moving toward populism. And so my question is, could it be possible that the EM discount, at least in these Latin American countries, and Lord knows Mexico is very impacted by a lot of the rhetoric coming out of Washington, could that discount go away? So I have upped my exposure, both public and private, to Latin American markets. Private equity in the form of agribusiness in Brazil, and also real estate in Brazil, and then a Pan-American long-short equity strategy.
You guys want to say anything about that? In Latin America or EM in general?
I was going to say, it's really political change, not political risk. You know, it's the upside of political risk, you know.
So, but granted,
what's counter-conventional?
People have been very people have been disappointed so many times in many of these countries, and I'm sure all of you in the room have seen this movie before. The only reason to believe it today is to say, is this a critical mass of a major trading region? And I guess I believe if the U.S. backs out, other countries will step in, like China, to fill the void of our very critical hemispheric trading relationship. So I see it as a positive, maybe a potential negative, talking about changes in trade policy, negative for us, but very positive for these Latin American countries.
I mean, we have an overweight to EM too, and also have some exposure to frontier, and I am hopeful that you are completely right. Yeah. I do wonder, is the comment we made before about time horizon, and over what time horizon, and do I know that that's going to work in the next quarter? I have no idea. Next year, not sure at all. Next 10 years, I think it should be a fantastic place to be, and that as long as you can have, I mean, you and I are fortunate to work for institutions which are very patient capital, and at Dignity Health, we're a very thoughtful investor in that way, and I really appreciate working for a organization and an investment committee who has that ability to tolerate potential short-term volatility. But I do think that there's tremendous potential in those markets and in others. So.
And when you bear the political risk in developing countries, there are things you can do, like demand a higher premium, depending on your time horizon. And I think any investor in the emerging markets needs to consider that. What is the premium that I need or expect or want in exchange for the risk that I'm taking? And then the other thing is diversification, but not just simply based on country or currency, but based on the source and type of political risk. Like, so for example, you look at China and you say, okay, what are the factors there as far as investing goes? Well, it's corporate governance, it's some conflicts of interest, it's an uneven playing field, and so that doesn't preclude you from investing, but those are the types of political risks, incentives, corporate management's incentives, those are the type of political risks that are going to permeate through your investments in equity and otherwise. And then when you look at a country like South Africa, for example, you have rising political risks in the form of corruption and crime and those kinds of things, and those are, stem from a different place. And the last thing I wanted to say is that what I think epitomizes political risk, geopolitical risk, is what we've recently seen with Turkey. I mean, to me, that's the poster child, because you and this notion of trying to predict what will happen in the future. You had you have a constitution, and you're expecting a certain kind of behavior from the government and so forth, and then all of a sudden, based on I think 51% vote, you go from a parliamentary system to a presidential system, and that presidential system is consolidating power under somebody who seems to have mixed intent in terms of what to do with that power. So.
On one or more of the panels here, they've shown charts of the Brazilian stock market in 2016 and the Russian stock market, and they're off the charts. So we addressed Brazil. What about Russia? Anybody want to talk about Russia?
That's the ultimate political risk situation. I have not, even though I am half Russian, I have a hard time investing in a country where there's not even a glimmer of a rule of law. I would have a hard. I would probably invest sooner in certain small frontier market countries than I would in Russia.
Such as? Any of them?
I would love to. I would love to get more comfortable with the Maghreb, the Mediterranean part of Africa. I'm invested in sub-Saharan private equity. Talk about political risk, but fortunately, in a 10-year to 12-year vehicle, I'm not feeling the pain of the Nigerian currency going down by 40%. Last year. So I have a lot of political risk in my portfolio, and so you could say, why would you tie up money in sub-Saharan Africa? But the reason is that the public markets do not at all reflect the nature of the economies in those. I think there's something like 37 sub-Saharan countries in Africa. So that's I need 5.6% real return to break even every year. So I am able to take that kind of risk. And I guess you touched on something, Alyssa. You know, it sounds very simplistic. What some of the things we're talking about is that, but you know, it's simple but not easy. And if it were easy, everyone would do it well. So that we really need to have excellent governance to be able to do the kinds of things that we're doing. You have to have trustees that understand that you may look stupid, and the market may tell you you're stupid, you're stupid, you're stupid for a long time. And if you have that kind of support from your investment committee, you as a professional investor feel empowered to go ahead and make those long-term decisions. But there's nothing particularly easy about it when things are not going your way. I also think that active investing maybe is going to be the best answer to political risk is active investing. So again, we're talking our own book here, obviously, but you know, I don't see how a passive index fund can help this discussion at all.
Right. And I would also say what you brought up really highlights how it matters whether you're talking about debt or equity. So for equities and sort of long-term private or public equity investments, what matters with respect to political risk is rule of law. You know, can you really own what you think you own? And also impact on currency. You know, because you can have a great company, but it's just getting clobbered by, you know, what's going on with the currency, so it's not worth it. But if you're talking about something like, you know, sovereign or quasi-sovereign debt, someone like Russia is very motivated to pay back their debt. You know, so in some, you know, from that perspective, it can be an attractive investment on the debt side.
I mean, in your comment on, or question on Russia, I mean, I think one of the other issues is diversification. I don't think right now I'd ever consider going into a Russia-only fund, but I'm very happy to have managers who are really thoughtful and know that market and who can make selective investments. I mean, people are like, okay, we're avoiding state-owned enterprises, we're going to buy some of the smaller consumer companies, maybe some that haven't been kind of, the PEs are very bifurcated in that market, they're very cheap and very expensive and not as many in between. But finding someone who can be opportunistic there, I'm very happy to have. Finding someone who has to invest there, I would not be comfortable at all.
Which is an index.
So if anybody has a question.
Political risk in Korea versus Russia, I would say.
So if anybody wants to tee up a question, go for it. While we're doing that, I will, so we got a mic down. So I want to ask about populism. So we all kind of know what it is, but it's also very amorphous. It's very hard to measure, and we see these anecdotal things. Is this something you can actually take into account when doing portfolio planning, or do you have to break it down into smaller bites?
I mean, there are pieces. So, and I think we've all probably thought about them a lot since, you know, in these recent elections, but certainly you can translate populism if it translates into nationalism, into trade. So that's a major concern in terms of...
So is there a way to tell when you're approaching the threshold where populism becomes nationalism?
It really depends on the platform of who's in office.
I mean, you just know when you see it? Is that...
It isn't necessarily anti-globalization. You know, populism isn't necessarily anti-globalization, but it frequently goes together.
Depends how far it goes, really, right?
Yeah. I mean, you know, and there have been some historical cases of populism that, you know, started with the best of intentions that really goes south into authoritarianism. Not saying that we're going there by any means, but you know, but it can definitely present a lot of challenges for markets, and you know, there's just a great deal of pushback in terms of income inequality that's sort of spreading around the world, and you know, people want change, and so I don't think necessarily just because we see markets be, you know, are a little bit more peaceful at times, it doesn't necessarily mean that
Have any of you actually changed anything because of something you can attribute to populism?
No, I mean, I think there is also a difference between rhetoric and what actually materializes.
Right.
And one of the things that I've taken some comfort in, frankly, with the new administration is that Trump has shown a willingness to get more information about some of the issues that he campaigned on, which were very populist and very anti-globalist, and sort of say, okay, well, maybe I can't immediately, you know, say China's a currency manipulator. Maybe, you know, the wall as originally envisioned will not completely materialize. Maybe NATO is not such a bad thing.
Maybe I should call Goldman Sachs first to see what they think.
No, but I mean, well, he has taken some input, but he also has been willing to sort of say, well, he doesn't say he's wrong.
That's right.
But he's been willing to step back on some of those that rhetoric. And so things that that might have materialized with someone who might have been more stubborn in their positioning have not turned out that way.
Okay, so go ahead.
Thank you. What do you?
Just say who you are, please.
Hi, I'm Daniela from the Central Bank of Mexico. What do you consider are the imminent risks for the European Union, specifically for the euro situation in a couple of years?
I think the French election is the next thing within, I think it's this month, right? I mean, I'm very much a Eurocentric person. I'm a globalist, so that I do hope that the European Union in some form will continue to exist, although it's clear that they cannot have the United States of Europe. You can't have a common currency without a common political system or government. On the other hand, it certainly has been beneficial for many members of the European Union. I personally would like to see Europe remain strong. I think it was a huge mistake that the UK left, and yet I guess that will be, we have 2 years of them working out the details. So I'm a terrible, I thought Trump would lose the election, so I feel like I'm not particularly good at predicting political things.
Most of us did.
Yeah. I take a lot of comfort from history. I've been listening to the Chernoff biography on the Morgans, and so talking about other populist regimes under William Jennings Bryan. I mean, you can learn a lot. So populism is not at all a new phenomenon here or elsewhere, and so having some historical context is helpful. I don't have a strong feeling about the future of the EU. It seems tenuous at this point.
The market seems, just to quickly comment, the market seems sanguine and seems really enthusiastic, and I think that's with some of the more pragmatic rhetoric coming out of the French election. So a lot of folks we're hearing saying that Europe is the next best investing opportunity.
Don't you think, Marina, that that's also a function of the fact that the cyclical economies are really looking very strong, and so you're at a better period economically on the ground in Central Europe than you have had for some time?
No doubt. And so as the political risks sort of fade away, primarily with what's happening with the election in France, then the fundamentals can rise and become a more prominent factor.
And relative valuations are
Good.
pretty good too.
Pretty good, yeah.
Does that make you feel better about Europe?
A bit, yeah.
A bit. Go ahead.
Let me see. Yeah, Martin Marina, representing a pension fund based in Switzerland. Let's just assume for a minute that indeed the free world will be governed by politicians who will assume that the voters are watching BBC and CNN on mute. Let's just assume that that's the new way of accepting kind of the things. Back to the portfolio strategy and back to the investments. Would you maybe have an advice for European investors or other investors having a lot of experience investing in South America, whether we should embrace the techniques of investing in emerging markets and taking these lessons for actually developed markets? So would the emerging markets lessons, investing in emerging markets, would that apply actually now for Europe? Or would it apply for even US a little bit? Because I'm not that convinced that Europe is in that great shape. We have issues which are similar to something you have seen here. So the emerging market techniques, emerging market techniques, investing there, applying
Ellen,
into the
I started.
You talk about a kind of convergence, right?
So I have thought of that. So, and I've heard some people say that if you look at the central banks of, we're talking about Latin America, but the emerging market macroeconomics are at the margin better in many countries. And so that what if in fact emerging markets are the grown-ups in the room, and their central bank balance sheets, et cetera, are in better shape. They have not done all this nutty monetary expansionism as we've done in the US and Europe and in Japan. So it does occur to me that you could have a flip-flop whereby a discount should be applied to the US and Europe relative to, we're calling them emerging markets, a lot of them have already emerged. So So I would be delighted to have a narrowing of a discount. I don't know, the U.S., we're still the reserve currency. China's a long way off from really challenging us. But yeah, I have thought of that. And I think that's something that gives me confidence at the margin to bump up my overall exposure to emerging markets, primarily equities and private equity. I do not have any emerging market debt for some of the reasons that my colleagues mentioned.
Anybody else want to address that?
I think that was exactly what I would say as well.
There's a question here, third row.
Julie Siegel from Institutional Investor Magazine. I'd love to hear each of your thoughts or some of your thoughts on Puerto Rico being placed into bankruptcy. What you thought in the last year or several years and what that means now.
I mean, I would just say this is another case of active management. We've sort of been watching this slow burn on Puerto Rico and living, almost day by day, this, what they're working through this week and what are they going to do, next week, and making all of these, trying to make little deals along the way. But for investors in Puerto Rico, I think they're just, they're experiencing what has been it's been a long thing coming. We've seen it coming for a long time. And I think that actually is a theme that applies to some of the, the political risk topics that we've been talking about. Sometimes you have this, these immediate reactions and, boom, the market goes down and then it recovers again. But others are really long, slow burns. And you can sort of see it coming. You just see the, the fiscal situation and the external debt that they have and investors can see it coming. And there's time to get out. You may have a loss along the way, but there's time to get out.
Has anything about Puerto Rico been surprising?
I was going to say that the market had priced, the municipal market had priced that in, whatever, 24 months ago. Mm-hmm. So there's now more news emerging, and now I think there was an article yesterday about bankruptcy court and so forth. So as you were saying, it's sort of this glacial process. But I think the market was had already dealt with it, way back.
My hedge fund investors that are more on the distressed side, I think it's been very frustrating because there hasn't been a big distressed event, and so that I am aware that a number of the managers whom I've allocated money to have done a lot of analytical work on Puerto Rico, and because there are several different pools of assets with a varying degree of collateral and covenants, so that it was a very legally intensive research process. Some passed, some bought specific tranches, but distressed investors, they love a really bad fast train wreck, and this has been a really slow train wreck. And I agree. I think Russia's kind of been Russia didn't just become the way it is today. That's an example of a slow-moving train wreck political risk, because I understand back from when Vladimir Putin was the vice mayor of St. Petersburg, he was already starting to say things that he says today, so that there would have been a way, had you been an investor in Russia before he was first elected, that you could see where the signs were headed. But sometimes it's really hard to put all the dots, to connect all the dots.
I think we've also had some hedge fund managers who've made very selective investments, and it's extremely important to really understand the collateralization, the legal structure, the priority of where payments go. And so people have been able to find opportunities there when they really understand the market, and that's, again, finding really smart managers who can understand situations even when they're very complex.
So let's take a question there, and then we'll go back there.
Dovetailing back to populism, and then the first question about
Europe. Who are you, please?
Oh, sorry, I'm Justin. I'm working at Pension Advisor. If Macron does win on Sunday, and if the five-star movement doesn't come to power in Italy, does that actually change the forces that are inspiring Le Pen and the five-star movement? In my opinion, I'm not sure Macron can suddenly make the rural French farmers competitive, or the people in Italy that don't all have jobs, so on and so forth, them suddenly become viable, workers, employees, and make them competitive, German, Nordic, whatever. Is that a longer-term concern? And I totally agree that we have to look to history as the guidepost here, but you could also argue as devil's advocate a little bit. There's a long history around the world of currency unions. and there's only one left.
And I think the fundamental issues that have driven that in terms of, again, the income disparity, the asset disparity that we aren't going away. All those folks who are supportive of those organizations are still there and still have those concerns and those issues. But that change in the trend or might make it a little bit of a peak. That would be, I would see that as a very positive sign if those things happened. With Macron and in Italy. But I think there's still a lot of issues that we do need to deal with across many developed countries to address some of the outstanding problems that we're facing.
Yeah, I mean, that's almost the most optimal outcome is that, somebody like that wins, but they don't have a complete mandate. So that some of the issues can be addressed over time, as opposed to just needing this radical change, sort of untested radical change that gets forced through. Have time to understand, okay, this is a real issue in our population. We have to deal with it, even though we're not going to be completely drastic about it all at once.
Doesn't Europe just muddle through indefinitely?
I think to be an investor, you have to have a belief that the world will muddle through, and that over time, growth kind of muddles along. And I don't think we'd have this panel if there hadn't been 4 or 5 trillion subtracted from the global economy since actually before the global financial crisis. And I believe it's that $1 trillion chunk that's been erased, and that's the difference between 3.6% growth and 2.4% growth. That's the reason you have the growth of these, that's what has led to this, maybe it is the extreme version of income disparity. So I do believe that growth globally is what you need to help improve these things, and Europe has just been muddling along for 30 years, and every time a new French president or prime minister has tried to actually reform the very rigid French labor laws, it's been very hard, very, very hard.
And don't forget that economies are cyclical. And don't forget that it was 2 summers ago when I traveled in Europe, the euro was almost 1.4 compared with the dollar. So it's not to say that it'll go back, and I'm not making any predictions, but economies are cyclical. And I actually think the developments in France are very, very positive, because France has sort of been patently in this very kind of sort of left kind of wing social part of the spectrum. And even if they make some progress, any incremental progress in terms of like Ellen said, sort of liberating, kind of liberalizing, the economy and so forth, and kind of the job market. I think any incremental progress will be of great benefit.
Question back there.
Yes, I'm Eric Noel with Oxford Analytica. I've been at political risk for about 30 years now. I grew a company. We have 1,400 analysts in 150 countries doing political risk, and I'm a bit uncomfortable when I hear people talking about political risk as an art or as a crystal balling and there is no model, etc. I mean, I'm not saying it's a science, but we've been working at it for several decades, other firms as well. And today you can find very good data that will help you predict the risk of policy change, expropriation, war risk, corruption, judicial risk, taxation risk, etc. And you can modelize that into models that will give you a better confidence than before in terms of what is likely to happen next in a country following an election, a referendum, etc. Anyway, I walked into this room thinking about the title, Mitigate Political Risk. I'd like to hear you about your mitigation strategy. Are you using political risk insurance? Are you co-investing sometime with sovereign wealth funds? How do you mitigate that risk? I'd like to be specific on the mitigation part. Thank you.
Well, I would just say I agree that it is certainly possible to take a very close look at. It sounds like you guys are doing a fantastic job taking a very close look at individual countries and understanding, the policy, the policy stability, the support for the government, the fiscal stability. I mean, there are many, many metrics, of course, that you could apply to individual countries and understand sort of what the framework is there. And I'm pretty sure that managers who do look very closely at these countries and on the emerging markets side and in the developed side are are attempting to apply things like that. That helps you understand the individual country, and from the sort of longer term investor point of view, again, the question comes back to, yeah, but what's going to happen in equities? What's going to happen in rates? What's going to affect my overall portfolio? So I don't think that investors necessarily need to apply something that really is specifically to mitigate political risk. It's much more about thinking about the overall asset allocation, balance of risk relative to what their objectives are and to what their exposures are. If you're looking at hedges, it tends to be, at the end of the day, equity hedges, rate hedges, volatility, currency, things like that, rather than sort of trying to narrow it down to political risk, unless you are a portfolio manager who is dealing specifically in those countries, and then it's incredibly relevant, I think.
So there are a bunch of firms that do this. Eurasia Group, run by Ian Bremmer, he's all over the place. Yeah. I think Rudy Giuliani does to some extent does work like this. Is this kind of research something you all subscribe to, and do you find this useful, or do you prefer to do this in-house? And can you do it in-house?
Oh, we subscribe. I mean, we have subscriptions and in-house, so yeah.
So in answer to your question, I guess I would have to honestly say I do not mitigate for political risk. I don't mitigate, but I know I know all the inputs that you're talking about relative to the countries or regions that I might be allocating money to. I guess it's because I'm not at all convinced that the rank score of Zimbabwe or South Africa it will inform my decision, but I don't have a lot of confidence between that knowledge and understanding and how it will be reflected in the asset classes I plan to use. And so in a sense, I'm delegating that assessment, and I suspect it really comes out in the form of a discount or an equity risk premium, whatever you want to call it, based on the kind of scoring you're talking about. And I have every reason to believe it's highly accurate. But knowing the what, I think you're saying this, doesn't really translate into how it will play out in the markets. And then again, it sounds lazy to say, but I actually believe that over longer cycles, it will be a rare case that I could be convinced that the cost of insurance or the cost of hedging will be justified by what happens. So I guess I am relying on the world somehow managing to muddle through.
Well, and that's, I mean, our level, again, is at that larger portfolio basis, and I do think it is really something where we expect our managers to be using research like Ian Bremmer's or the work that you're doing to really understand those underlying companies, their risks, and again, it's not the only risk that those managers look at. They have to look at valuation, they have to look at a number of different other risks that are involved in making an assessment of what they expect the return out of something to be. One of our global bond managers made an investment a number of years ago, which was US-backed Iraqi bonds that were yielding 17%. So it was Iraqi bonds that scared away everyone, but the fact that the US government, frankly, was going to back that gave it tremendous upside potential in terms of really getting that return on it. And so being able to find folks, again, who can make those assessments, who can understand the companies and countries in which they're dealing is really key to what we're doing.
Let me just a quick point to that. In my view, mitigating political risk is in many ways counterproductive. You're going out by investing in emerging markets or frontier markets, you are consciously, overtly assuming political risk, and you expect to be compensated for that. So if you're uncomfortable with political risk, then don't invest in those areas. But to try to invest in those regions, in these nascent economies, and then try to hedge that political risk seems to me like it's cognitive sort of dissonance.
So we're almost out of time, and I'm going to ask this really quickly. North Korea, it's kind of a binary event, low probability, high impact if there's some kind of confrontation there. Is this something are you guys accounting for this in any way at all in your portfolios?
So I have a big exposure. I'm overweight in Japan. I like Japan a lot. I've liked Japan a lot for the last 5-6 years, and also have private equity investments in China. So I would very much be exposed. I have not And I passed on an additional direct investment in South Korea. I did not do it because of the geopolitical risk, but so the answer to your question is no, I have not.
Okay, we got. If anybody else wants to add to that.
No.
I would just say it impacts overall risk appetite. So one day something's going to happen, whether it's North Korea or something else, vol's going to go up, and it's going to affect equity markets.
So I think that my takeaway is don't be afraid. Am I getting that right? Sure. Okay, thank you everybody, and thanks for coming.